$382 trillion. That's roughly the value of assets that pass through the hands of just 3 banking institutions every single year. Not governments, not central banks, not the names you'd guess. You've probably never used these banks. You've never opened an account with them. Most people couldn't name them if their savings depended on it. And yet, your paycheck, your mortgage, your pension fund, your country's government bonds, and the stock in your brokerage app all move, at some point, through their pipes. They don't make headlines. They don't run ad campaigns during the Super Bowl. They don't want you to think about them at all. This isn't a conspiracy theory. It's not a secret society, and there's no smoke-filled room. It's something stranger, and in some ways more unsettling. A small number of regulated, publicly known, thoroughly boring-sounding companies that happen to sit at the exact center of how money physically moves through the modern world. Today we're opening up the plumbing, not the banks you see. The banks that make the banks you see actually work. The bank behind your bank. Let's start with a question that sounds simple but isn't. When you buy a share of a company on your trading app, who actually holds that share? Not you. Not really. Your broker holds a record that you own it. But your broker doesn't personally safeguard millions of individual stock certificates in a vault somewhere. That job, the actual custody of trillions of dollars in securities, belongs to a tiny handful of firms called custodian banks. There are really only a few players operating at global scale. BNY, formerly Bank of New York Mellon, State Street, and J.P. Morgan Chase's custody arm. Between them, they safekeep or administer trillions upon trillions of dollars in stocks, bonds, and other assets on behalf of pension funds, mutual funds, insurance companies, sovereign wealth funds, and other banks. Think of it like this. Your bank is the shop window. These 3 are the warehouse behind every shop window on the street. When a mutual fund in Ohio buys a bond issued by a company in Germany, somewhere in that transaction, a custodian bank is holding the actual legal record of ownership, making sure the interest payments land in the right account, and confirming the trade actually settled. This isn't shadowy by design. It's shadowy by disinterest. Nobody outside finance has a reason to learn what a custodian bank does. The same way most people don't know who manufactures the components inside their phone. But remove that layer, and the entire system of modern investing stops functioning within days. That's the first piece of plumbing. Who holds the money's paperwork? The machines that never sleep. Custody is only step 1. The next question is, how does ownership actually change hands? At the moment a trade happens? This is where clearing and settlement come in, arguably the least glamorous, most important 2 words in finance. When you buy a stock, there's a gap between the moment the trade is agreed and the moment money and shares actually change hands. In the United States, that gap is handled largely by an organization called the Depository Trust and Clearing Corporation, or DTCC, a firm few outside Wall Street have heard of, which in a typical year processes securities transactions worth over $2 quadrillion. Yes, quadrillion. That number reflects the total value of transactions processed, not net wealth, but the scale still tells you something about how much traffic runs through this single node. The DTCC isn't one of our 3 banks. It's a market utility jointly owned by the industry. But it works hand in glove with our custodian banks because they are often the ones actually instructing and confirming these settlements on behalf of their clients. Now, zoom out to the international level. When money needs to cross borders, say, a pension fund in Canada buying government bonds issued by France, someone needs to actually move the cash between currencies and jurisdictions, confirm the trade under two different legal systems, and manage the risk that one side pays and the other doesn't. This is where global custodians again become central. BNY, State Street, and JP Morgan don't just hold assets. They run some of the rails that allow this cross-border settlement to happen smoothly, acting as intermediaries between different national systems that otherwise don't talk to each other. Here's the important nuance. None of this is secret. The DTCC publishes its statistics. These banks file extensive public disclosures. Regulators, the Federal Reserve, the OCC, the SEC, supervise them closely, precisely because of how central they are. What's hidden isn't the information. What's hidden is the attention. Nobody's watching, not because they can't, but because it never occurred to them to look. The language money speaks. Now, let's talk about something you may actually have heard of: SWIFT. SWIFT, the Society for Worldwide Interbank Financial Telecommunication, is not itself a bank. It's a messaging network headquartered in Belgium that lets banks around the world tell each other things like, "Send this amount to this account," in a standardized, secure format. Here's the part people miss. SWIFT doesn't actually move money. It moves instructions. The money itself still has to travel through a chain of what are called correspondent banks, banks that hold accounts for other banks, specifically so international payments can be routed through the financial system of a given country. If a small regional bank in, say, Southeast Asia wants to send a dollar payment to a business in the United States, it likely doesn't have a direct relationship with the American banking system. Instead, it uses a correspondent bank, very often one of a small number of large American institutions, again frequently including JP Morgan, that has both the local relationships and the dollar clearing infrastructure to make that payment actually land. This is why when a country gets cut off from SWIFT or loses access to correspondent banking relationships, its economy can be crippled almost overnight. Not because someone flipped a switch on the money, but because the instructions and the routing both depend on a small number of choke points. And those choke points sit inside a small number of institutions in a small number of countries. It's worth pausing on why this matters politically as well as financially. This structure means that decisions made by regulators and banks in one or two countries can have consequences for the entire global financial system. That's not a hidden fact. It's a well-documented feature of how modern sanctions and financial policy work. But it is one most people never think about until it makes the news. The overnight machine. Here's a piece of plumbing that almost nobody outside finance has ever heard of, and it might be the most important one of all: the repo market, short for repurchase agreement. Every single night, trillions of dollars move through short-term loans where one institution, often a bank, a hedge fund, or a money market fund, lends cash to another overnight, using government bonds as collateral. It happens, gets unwound, and happens again, every business day, like a heartbeat underneath the entire financial system. Big custodian and clearing banks, again our familiar names, often sit right in the middle of this market, acting as intermediaries that match up who has cash and who needs it, and who holds the collateral that makes the whole exchange trustworthy. Most people never think about the repo market until it breaks. It broke, briefly and alarmingly, in September 2019, when overnight lending rates spiked unexpectedly, and the Federal Reserve had to step in with emergency cash injections just to keep the machine from seizing. Almost nobody outside financial media noticed. But for a few days, one of the quiet gears that keeps global finance moving nearly ground to a halt, and very few people watching the news that week had any idea why it mattered. That's the pattern with all of this plumbing. It's invisible when it works, and briefly, confusingly visible when it doesn't. Why so few hands on so much money? So why does this concentration exist at all? Why isn't this spread across hundreds of competing firms? Part of the answer is scale economics. Running global custody, clearing, and settlement infrastructure requires enormous, continuous investment in technology, legal compliance, and risk management across dozens of jurisdictions. That's an extraordinarily high barrier to entry, which naturally narrows the field to a small number of firms large enough to do it well. Part of the answer is trust and regulation. Regulators generally prefer concentrating this kind of infrastructure in institutions they can supervise closely, rather than having it scattered across less accountable players. In the wake of the 2008 financial crisis, regulators around the world formalized the idea of systemically important financial institutions, firms whose failure could threaten the entire system and which therefore face tighter oversight and higher capital requirements. All three of the custodian banks we've discussed today sit on those lists. And part of the answer, frankly, is inertia. Once a handful of institutions become the default plumbing everyone relies on, the cost and risk of switching to a new provider becomes enormous. That kind of entrenchment is common in infrastructure generally. Think about how few companies actually run the undersea cables that carry the internet, or the handful of firms that operate global shipping ports. This is the honest answer to why do three banks quietly run so much of the plumbing? Not because of secrecy or conspiracy, but because of a mix of economics, regulation, and historical accident that concentrated critical infrastructure in a small number of hands, the same way it has in telecommunications, shipping, and cloud computing. That concentration is exactly why it deserves scrutiny. Systems this concentrated carry systemic risk. If one of these institutions suffered a catastrophic failure, cyber attack, or operational breakdown, the disruption could ripple across the entire financial system far faster than most people would expect. That's a legitimate concern raised by economists, regulators, and policymakers, not a fringe theory. What this means for you: none of this changes your daily life directly. You'll still get your paycheck. Your mortgage payment will still go through. Your retirement account will still show its balance on Monday morning. But understanding this plumbing changes how you understand risk. It explains why a glitch at one obscure clearing firm can freeze trading across an entire market. It explains why international sanctions can be so effective and so disruptive so quickly. It explains why regulators pay obsessive attention to a handful of institutions most voters have never heard of. And it's a useful reminder that power in modern economies isn't always about who has the most money. Sometimes it's about who controls the pipes the money travels through, and how few people are actually watching those pipes at any given moment. Final thought. There's no villain in this story. No secret cabal deciding your fate from a back room. What there is, instead, is something arguably more important to understand. A small number of institutions, hiding in plain sight, doing unglamorous work that almost nobody bothers to ask about until the day it breaks. The next time you hear about a market freezing up, a country losing access to global payments, or a bank's name flashing briefly across the news before disappearing again, remember the plumbing. It's usually the plumbing. If this pulled back the curtain on something you'd never really thought about before, that's exactly the kind of story this channel exists to tell. The hidden systems running quietly underneath the world you already live in. Share this video with someone and drop a comment. What system do you want us to pull apart next? The internet's physical backbone, the global shipping network, or the power grid? See you in the next one.